Setting up,
Live stream.
and live stream is up.
Mhm.
I think
All
we
right.
have the, looks like we have the AI companion working.
Transcription. Yeah. Let me know when you want me to hit admit all and make sure we mute.
Would say, do it now.
Okay.
Hi, I'm well. How are you? Doing okay. Camille, look at you, shipping and receiving. What's going on here?
Hey, we have muted all. And I'm going to unmute David and Carl.
Did Bill freeze again? He did.
Hey, Carl,
Yes, hello.
you're up.
Yeah.
Okay, welcome everybody to the September meeting of the Fiscal and Economic Issues Group. Having a little bit of technical troubles tonight, but hopefully those will go away soon. In any case, here's our presentation for tonight. And I'm not going to try and share in the chat the link to the presentation. So hopefully Christine or Bill can do that. Anyhow, as I said, tonight's the September meeting of the Fiscal and Economic Issues Discussion Group, where we help you understand what the facts are and sharpen your arguments, communicate. And here's a link to the slides and the video. A little humor from David. But anyhow, when Trump took over the economy on January 20th of this year, we had perhaps the best economy in 50 years from Biden. The lowest unemployment rate, the highest real wages on average among the last 11 presidents, a record real median household income in 2024. The economy is starting to show the initial adverse effects of Trump's policies in jobs, GDP, and inflation. We've got the tariffs, we've got the one big beautiful bill, and various other things that are impacting the economy. So we've got, from the Establishment Survey of Employers, job creation of 22,000 in August. In June was revised down to a loss of 13,000 jobs, the first officially recorded negative month since December 2020, the last time President Trump was in office. The 3-month average job creation is only 29,000 versus 168,000 average in 2024 before benchmark adjustments. The unemployment rate increased from 4.2 to 4.3%. It's still historically low. Stocks are up 7.2% from Trump's inauguration. CPI overall was 2.9%, and CPI core inflation in August was 3.1%. The Fed's preferred measure of inflation, PCE core, was 2.9% year over year in July. We won't know the August number until the end of this month, so a couple more weeks. Real hourly wages, purchasing power is at a record level, but it's unchanged versus the prior month and up 1% versus a year ago. And the Trump One Big Beautiful Bill law scored by CBO and private think tanks has a large deficit increaser of 3 to 4 trillion. That also increases the number of uninsured by 10 million via cuts to Medicaid, as well as reductions in subsidies for those people who are actually buying their insurance through through the exchanges. Tariff revenue may offset some of that if it is sustained, but the lower courts have ruled against the legality of the tariffs. We'll have to see what the Supreme Court does. And this is an update to the CBO economic forecast. Came out in September versus January. In January, we were projecting the year annual real GDP growth of 1.9%. For this year, we're now projecting 1.4% of the CBO is. Bouncing back in the 2026, and then coming down again in 2027, 2028. Inflation, CBO is projecting 3.1% inflation for the year. I hope we hold it to that. And inflation coming down to 2.4% next year because the tariffs won't be new. Unemployment rate, they expect it to go up to 4.5%. At the beginning of the year, they were projecting it would only go up to 4.3%. And expecting interest rates to be a little higher than they were expecting at the beginning of the year. So what is the Trump policies going to do for different income groups? Basically, if you're in the top 10%, you're going to do really well. If you're in the top 20, the next 10%, you'll basically break even, be a little ahead. And anybody in the bottom 80% is going to be worse off between the tariffs and the One Big Beautiful Bill. So the monthly jobs report is perhaps the most important economic news release. The net number of jobs added or lost helps tell us the strength and direction of the economy. Historically, we've said 100 to 150,000 jobs added in a month indicates steady as she goes economy. With lower immigration, it may be a little bit lower to get steady as she go. There's about 160 million payroll jobs in the establishment survey. This, of course, does not include your Lyft and Uber drivers and Grubhub and various other independent contractors. So it also excludes agriculture and the self-employed. What we see is that jobs grew 22,000 in August, but the prior months were revised down by 21,000. So compared to last month, we're looking at an additional 1,000 payroll jobs. See is that prior to the pandemic, we were at 152 million. This was an all-time high. We lost 22 million jobs in a couple of months, March and April of 2020. We'd started to recover. And in one of Trump's last months, we actually lost jobs in December of 2020. But by June of 2022, we'd regained all the jobs that we'd lost since the pandemic started. And so we're now about 7.25 million jobs more than we had pre-pandemic. What we see here is the monthly change in jobs over the last year. This is before the adjustments that we'll get to. Basically, okay, and the preliminary benchmark reduced March 2025 jobs levels by 911,000. So from 159.3 million to 158.4 million. We don't know, and we won't know until early next year exactly how that gets spread. So for purposes of this, we've spread it evenly as a $76,000 reduction monthly. And so we see as the reported number and then the post-benchmark revised number. This is where you can see what we've done with the adjustment. Again, we spread it evenly. And then there have not been any adjustments yet from April 2025 forward. For basically what they do is they survey employers every month, and they report their payrolls, but then they revise those payrolls over the next 2 months, which is why you get those sorts of adjustments that we've talked about. But then at the end of the year, they go ahead and look at payrolls per unemployment tax filings to get a better indication of what the true payrolls were. And that's what these sorts of adjustments we will expect to be based on, but we won't get the finalized numbers for these until early next year. Anybody confused yet? Okay. Federal employees, between Elon Musk and the president and all, we've laid off, well, we have officially about 100,000 fewer federal employees than in January. However, we know, based on reporting, that over 260,000 federal workers have already been fired or have taken buyouts, retired early, or have been earmarked for termination. And so what this means, workers on paid leave, down here in the notes on the bottom right, workers on paid leave or severance pay are still considered employed. If they were private employees collecting unemployment, they wouldn't be considered employed. But because they're federal employees on these paid leave programs, took the Elon Musk buyout, et cetera, they're still being paid by the government, and therefore they're still considered unemployed in the establishment survey. So we expect that by year end, over another 100,000 more federal employees will no longer be counted. Okay, the other thing that we talk about every month is the unemployment rate. This is a separate survey. It's based upon calling up 50 or 60,000 households and asking a bunch of questions. But to be considered unemployed for the U3 unemployment, which is the most widely reported, person has to have looked for work actively in the last month, be available for work, and have not worked a job, even an hour. So the unemployment rate tells us what percentage of the labor force is not working. Historically, it's been up around 5.7. So we talked about it's currently about 4.3. And the Fed probably doesn't want unemployment to be much below 4% currently because they think that would be inflationary. Okay, and here's to talk about the historic level, 5.7. The Trump started at a 4.7% unemployment his first term and left with a 6.4% unemployment. He'd gotten it down to 3.5 before the pandemic. Then we lost the 22 million jobs in March and April. It bounced up to 14.8%. And it came back down, actually reached a new recent low of 3.4% under Biden before going back up. And I think it was 4.2% when Biden left office, and it's 4.3% now. And this is the change in the household survey from July to August. And actually reasonably good news. The population grew, the labor force grew, the number of people employed grew, the number of people unemployed actually grew, which is not so good, which is why the unemployment rate went up slightly. It was just under 4.3% on a rounded basis at 4.24 something in July, and it's now at 4.32%. And it may keep going up, we don't know. And if we look at just the Trump months from January to August, we see the population grew, the labor force didn't grow nearly as much as in the 1 month. And pretty much all the other results are negative. The number of people employed are down 500,000. The unemployed is up over 500,000. And the prime age unemployment to population ratio, prime age is 25 to 54. This tends to exclude students and retirees. And a civilian non-institute population, so it excludes military, incarcerated, mental hospitals, etc. So what we see is it was a relative high right before the pandemic, big drop during the pandemic. It's been recovering since, and it's now just about where it was before the pandemic. Bad news if you're looking for a job, not terrible news. There are about as many job openings as there are unemployed at the moment. Slightly more unemployed than there are job openings, but not by much. But if you go back to earlier in the Biden's term, we see that at some point in 2022, there were about twice as many job openings as there were number of people unemployed. And so we had a lot of quitters and job hoppers who were moving for better wages. We don't have that now. And so we've got people who are sticking in their jobs and new graduating students struggling to find their first job. So what's happening with the current labor market? It appears to be in balance. Basically, people are staying put. Unemployment rate slowly rising. Slow job creation. The June negative 13,000 was the first negative since 2020. The number of open jobs is slightly below the number of unemployed for the first time since the pandemic. The employed level is below January, while unemployed is up. We've got a reduced flow of immigrants. Now, if we're looking at strength, we see the low unemployment rate, a high employment population ratio for prime age workers, stable work week hours, wages growing a little faster than inflation. Job growth is in healthcare and leisure hospitality jobs. So I guess if you want to be a bartender or a waitress, you're in good shape, or better shape anyhow, and low layoff rates. And this is sort of a long-winded quote from the Fed chair. I will note that the Fed is meeting this week and will likely revise the interest rates or vote on revising interest rates. Speculation is strong that they will lower the interest rates by 1/4 percentage point tomorrow. So were there questions about the economic overview or the labor market?
We just had one in the chat about the employment numbers. Do they include undocumented workers? And the answer is yes, they do.
Okay, thank you. So let's go on to household finances. So real median household income was at a record high in 2024, up 30% since 1985, and real means adjusted for inflation. Different components of prices have gone up at different levels. So house prices have gone up a lot, but food and other things have not gone up nearly as much. Clothing is not, etc. So there were only 2 years when the poverty rate was below 11%, 2019 and 2024. We discontinued a number of government programs, so it's probably going to go back up. Health insurance is tied for the second lowest ever. We see that it was uninsured rate was about 14-15% back when the ACA was passed in 2010, came down, went up a little bit under Trump, came down under Biden, and now with the big beautiful bill, it looks like it's going to go back up, as over 10 million people are likely to lose their health insurance. Inflation. And these are the monthly changes in inflation rate results based upon the overall CPI as seasonally adjusted. So we see is that it was growing a year ago. It kind of crashed earlier this year, but then it picked up, and the 0.4% rise in August was a significant rise in the inflation rate. And again, these are CPI the core inflation rate, excluding food and energy, is actually higher than the rate that includes food and energy. Gas prices have actually gone down over the last year, although they've come up since Trump took office. Not by much. So what we see is that core food, excluding food and energy, inflation rate year over year is at 3.1%, which, if we didn't have the problems with employment, the Fed might be thinking about raising interest rates and not lowering them. And here we can see the various components. And what we see is that gas prices are actually down 6.6% versus a year ago. Natural gas prices are up, although they've come down in the recent months. So for those of us that have gas heating, we're not looking forward to winter. And PCE inflation comes out a few weeks after the CPI. Usually comes out in the last week of the month for the prior month. So we'll expect these are July numbers. We'll expect to see August numbers during the last week of September. What we see is that the PCE core inflation is at 2.9% and overall at 2.6%. And those are both up a little bit since earlier this year, which is not going to make the Fed happy, and why we may not see a lot of rate cutting this year, especially if the core PCE core inflation keeps going up. And now we're diving into the leaves. So what we see is the core goods inflation has gone up a little bit because tariffs are applying to goods, not services. And so services and housing services have been flat and declining, where goods inflation are now rising now that we have the tariffs. And as this points out, don't expect prices to go down once they go up. But the falling prices really isn't a problem as long as wages go up by more than the prices do, and that is what has happened over the course of decades. So we've got real hourly wages at a near record level. And the peak was actually during the pandemic, when we laid off 22 million, mostly low wage workers. So the average of the people who still had their jobs went up. Total wages went down, but the average wage went up. And then as we rehired waitresses and other bartenders and other people who'd gotten laid off, the average wage went down. And so when Biden took office, the average wage was $30.99, $30.99, and we're now up to $31.46. And we're now up to housing, and I think I was going to let David take over these issues.
Sounds good, Carl. Do you want me to share my screen or do you want to keep sharing this one?
I'll stop sharing.
All right. Christine, can you see that?
Yes, I'm seeing this screen that you're sharing.
Good. All right. I want to make sure. I always have a drama with that. So we'll talk about the housing market. And we usually take a break around 8 o'clock. So you hang in there a little longer. We don't do the housing market every month. This is something we'll just throw in every now and then. Also, we didn't do budget really this time. We've got the annual budget information will be coming out soon for the full fiscal year. Fiscal years run October to September, so we'll go through a pretty detailed budget module most likely next month or the month after. And those of you that have been on the call, we hit tariffs really hard the last couple of months, and we hit OBA before that. So we're hitting a variety of topics. We try to mix it up a little bit. So home ownership rate is about 65%, which it was right before the pandemic. So it's sort of a middle of the road, pretty sustainable level. When you look back at the fourth quarter of 2004, when you had the giant housing bubble, you got home ownership up to 70% or 69%, but I think we all know how that worked out. And people had massive foreclosures, and people had to give up their homes. It wiped out most of the net worth of the bottom 50% because most of their net worth was tied up in highly leveraged homes. They had borrowed a lot of money to buy these houses that were at elevated prices, and then the prices tanked and they lost all their net worth. So right now, this is a fairly middle of the road number, but it's not high or low. So when you hear a lot of news around housing crisis, we have to be careful in explaining what that is or what it isn't. It's not because there's an unusual level of home ownership. Right now, 65% of households owning the home they live in is historically pretty typical. And let me be clear about that language. 65% of the households own the home they live in. It doesn't mean that 65% of the people, men, women, and children all own homes. It is households. That 65% of them are owned homes, meaning the other 35% approximately are rent. What else do I want to say here? That's that. When you look at it by age, as you might expect, as people get older, the home ownership rate goes up. Elderly actually have nearly an 80% home ownership rate. So in other words, about 20% of elderly rent. The other 80% are homeowners, or they live in a household that the home is owned. And then it comes down, with the different ages, the under 35 group. In general, that orange bar, there was a little spike upward in the middle of the Biden administration. It was the third quarter of 2022. And that's what that orange bar is, just to give you a sense of the high point of the Biden administration. And then it's come down a little bit into the first quarter of 2025, which Carl and I often say is we still consider that sort of a Biden quarter ordinarily. This time was a little weird because of the tariffs and all the stuff that Trump put in on day one that sort of shocked the markets. But just so you know, the first quarter, arguably a Biden quarter. That's kind of where things stand. They sort of went up, peaked during the Biden era, and came down in terms of the short term over the last few years, but still fairly consistent. Every group, the under 35 is just slightly below where they were before the pandemic. In terms of housing prices, been on kind of a roll here. The houses went up quite a bit, peaking in the sort of middle 2022 timeframe. And that's when the net worth of the bottom 50% and other groups too hit the highest ever, even adjusted for inflation. We became the richest ever as a country adjusted for inflation. And right at the end of 2021, the first part of 2022, depending on the group. And a lot of that was driven by housing. Housing is the main asset of the bottom 50% of the population. And the house prices hit that peak of 481, adjusted for inflation, and are now about 410. There are different measures of housing indexes that show prices at different levels, but this is houses that were sold in the United States. So not just stuff that's listed, it's actually sold. These are the prices that have come in. So they've come down quite a bit and aren't that much higher than they were before the pandemic, adjusted for inflation. When you look at different ways that people value home prices, sometimes they look at like a value of price relative to rent. I like that one. This one tells you how many hours of work it takes to buy a home. at the typical wage of a production and non-supervisory worker, which are sort of the hourly bottom 80% of the market. So it's sort of a good measure of the middle class. It's not distorted by the higher management and the salary workers. It's the hourly workers. And so at the peak or at the bottom, you're looking at 8,000 hours to buy a home. And then now it's almost, it went up to like 13,000 in July of 22 when I showed you that was when the prices were the highest they've ever been. And now it's more like 11,008, still extremely high historically, other than the sort of bubble in August of 2006. So we sort of had this bubble even higher in terms of housing prices in 2022, and they've since fallen back, but they're still very high. The prices are still very high historically, adjusted for inflation, or in this case, in terms of the number of hours of work. In terms of mortgage rates and what that does to the expense of buying a home, mortgage rates recently were 6 1/3 approximately. We didn't check them this week, but it's likely they'll be falling as the Fed officially is likely to lower the interest rates tomorrow. But there is some disconnection between what the Fed does with the short-term interest rate, that's what they control, and what happens with the long-term rates, which is where the mortgage is driven from. We'll see if those long-term rates drop. They have been over the past couple of weeks, they've been falling. Now, when you look at the mortgage rate, assuming a home of about 400,000, which is what I said is approximately where homes are now, on average, if you're getting a 30-year mortgage, so you've got 360 payments, the monthly payment at 3% is about $1,500, but at closer to 7%, it's $2,300. $800 or $900 a month more is quite a bit for a typical family. So that's why when you hear housing crisis, it's often people that want to buy a home and have never done it before, so they're probably renting today. They want to buy a home. It's very difficult for them to break into home ownership, and home ownership is one of the great ways for the middle class to build some net worth. And so that's where, when you say crisis, let's just keep it in perspective. It's not a crisis for 65% of the people that own homes. It's an issue for those 35% that are renting. Also, there are people that would like to downsize from the homes they have. Maybe they're retired, they're empty nesters, but the home that they have and the home that they would like to downsize to, just the prices just aren't all that different. You'd be giving up your house for a lot less house. And if you're still carrying a mortgage and you have to refinance, you get nailed with these much higher monthly payments. So there's a lot of people that are sort of frozen in their homes, and I'll share some statistics on that for you. If you're interested in this stuff, the National Association of Realtors does a great monthly presentation and sort of data dump that you can look at if you ever want to get sort of the lowdown on what's going on with housing. So this is an example of one of their slides. What they're showing here is that existing home sales are down about 40% from where they were even in 2021. They're just way, way down as interest rates have gone up. Housing inventory, these are in thousands. So the left chart, there are about 1.5 million homes out there that are for sale. That number's come up a fair amount in the past year or so. This chart shows about the past 2 years, actually. And then the months of housing inventory. How many, if at the current rate of sale, how many months of housing inventory is out there? 4.7 months of housing inventory is sitting out there. That's a lot over the past couple of years. The math's a little convoluted, but that's what it is. In terms of the construction of housing, what's going on in terms of permitting? The Census Bureau does a nice monthly report on this as well. I stole this chart from them. It's a little bit difficult to see because you've got three, sort of the spaghetti issue of three lines sort of close together. But what you see out of there is the permits and completions are trending down a little bit, which is interesting because the permits are up front and the completions are at the end. And in the middle, the starts are kind of up. So there's still a lot of fluctuation, but you can see the trends aren't the same. They're coming down a little bit for the permits and completions, and then going up a little bit for starts. So we'll see how that plays out over time. But going back 4 or 5 years, you can see these numbers are a little bit low. They were still, like, if you look at, say, which would be, I guess, December of 2020, 21, early part of 2022. You can see the numbers are higher on these two guys, quite a bit higher. The green, pretty similar. The completion's pretty similar. So this is one way of tracking kind of the activity that's out there. It's a little bit low from where it was when the interest rates were lower. Foreclosures are not an issue right now. They jumped enormously, as you were aware, from during the Great Recession, and then they are not, very particularly high right now. There isn't a lot of stress, it seems. We don't see a lot of indicators of pressure on homeowners in terms of losing their homes. Bear in mind also that a lot of homeowners locked in those 30-year mortgages before these interest rates went up. They were even locked in before the pandemic. And so when you have high inflation and wages going up, it's actually a lot easier to pay off that mortgage because that mortgage payment was a fixed monthly amount. And so you got a much higher wage base to pay that down. People always think that inflation hurts everyone, but it actually helps debtors, assuming your wages are keeping up with inflation, which they did for most people. Now, there's a lot of noise in the news about, what is the effect of big corporations owning housing? I think it's a progressive boogeyman. None of us like it. My understanding of it from kind of doing a little bit of research here, I'm not an expert on these. We don't analyze this data every month. It's in certain markets. And so this GAO report, I think, is a great place to start in your research if you're interested. The report's from May of 2024, but the data lags a couple of years. So what do you see here, though? You see the states in the old Confederacy. There are certain cities where people have bought in an enormous amount. These investors have bought a ton of the property. But nationally, it's not a very high number. Nationally, it's more like 3% of all the single-family rental homes are owned by these big investors. But in certain markets, it's these high percentages, like Atlanta, 25%. Jacksonville, Florida, 21%. So they have more power there, obviously, to raise rents above maybe a more competitive market with much smaller types of, where there's a lot more competition. So I think the way my takeaway from this was that big investors are messing up certain markets, but not nationally. It's not everywhere, but it is definitely affecting the rents in certain locations. So more to come on this when we maybe dig into this in the future, kind of build on what we learned a little bit here. But that's a good report to start with. And there's another one, I didn't share it in here, but the Urban Institute, the GAO references it. You'll find it quickly if you look for it. The Urban Institute also does a study of this, and they've got a lot of other useful information in there. So let me pause there, maybe ask Carl for some help. I haven't looked at the chat while I was sharing that. Any discussion of housing? Any questions?
I'm not seeing any questions that you haven't covered, but
Okay. We can always get to the end here. We are making record progress on this. We are zooming through these slides, so we may go back and cover a couple of things in a little more detail. But let's go through the next section, or at least start for 15 minutes or so. We had a lot of questions in the last couple of meetings. I wanted to make sure we get back to them. There were some interesting ones. So some a little wilder and crazier, but that's okay. We're a wild and crazy bunch, as you can tell. So did Russia and Iran get oil deals as part of the solution to the Israel-Iran conflict? Looked it up. They actually got a deal before. Russia and Iran made a deal in April before the 12-day war in June. The Russian companies paid to develop oil fields in Iran, and Russia will provide natural gas to Iran, was the deal. So there was definitely some wheeling and dealing between Russia and Iran. As you know, the U.S. has a ton of sanctions on Iran in terms of what they can do with their oil. So obviously, Russia is a great place for them to sell it. And then Russia is selling its natural gas to them. Anything about small business bankruptcies? Have the tariffs started to really slam these small businesses? And it's too early to tell, I think, is the answer. I was looking for business bankruptcy data, and they were just higher in 2025 than the last couple of years. But there's been no data really on that would show an upward trend. It's just not available yet, starting sort of in the second quarter or later of this year. So we'll keep an eye out on that. The Chamber of Commerce put out a really anti-tariff piece saying, this is, as much as they're bragging about, 200 and something or $300 billion in annual revenue, a lot of that comes off of the backs of small businesses that are paying more in taxes. And the Chamber of Commerce, a very conservative organization, as you know, is not happy about that. So we'll see, but no news yet on bankruptcies. Doesn't mean it's not happening. We just don't know.
Anecdotally, we're hearing about farm bankruptcies, and farmers in great amounts of distress, but we don't have the data accumulated in those yet.
Yeah. Oh, good point, Carl. And there's always talk about bailouts. There was a bailout or a series of bailouts the first time in Trump's first term for farmers, and then there's likely to be another set here coming up. We export a ton of our soybeans, for example. I saw an interview with a farmer today. They were exporting a lot of soybeans to China, but China has retaliated and said, we're not going to buy them. So they've got like a quarter of their production is sitting. They're trying to figure out what to do with all those soybeans. So the NVIDIA deal with China, lots of complexity in there. There's lots of intrigue. It would probably make a great spy movie. NVIDIA makes, if you've been following the stock market, NVIDIA has shot through the roof. It's in this incredible, I'm going to call it a bubble, but who knows? The earnings are tremendous. The company's making and growing incredibly fast, making money hand over fist because it's got sort of the market locked on these chips, which are used in AI, on building AI models or building AI intelligences. And nobody else has quite the same thing. They've got stuff that may be close, but NVIDIA is the leader. And if you know your chips, if you're a PC buyer over the years or you bought them for your kids, NVIDIA is gaming chips. That was their sort of thing for a long time. So we restricted the sale under Biden. We restricted the sale of those advanced chips to China. And then Trump has expanded that further. So NVIDIA created this thing called the H20 chip to be legal. It was designed on purpose to follow the guidelines that Biden and Trump put in. But then Trump said, no, you can't even sell that to China. So then NVIDIA and AMD, another big chip corporation, they said they would pay 15% of their revenue to Uncle Sam in exchange for export license so they could send this stuff, so they could send this H20 chip over to China. And NVIDIA is projecting 20 billion in sales from that. So this would be about $3 billion going to the government. So I'm not a lawyer, but the legality of this is very questionable. It sort of looks like a Uncle Sam shaking down a U.S. business. NVIDIA may have gone along with it because they want to sell the chips. They probably, let's say they have a 50% margin on those chips. So 3 billion, they're making 10 billion on those chips and they got to pay 3 to Uncle Sam. They're more than happy to do it. So we'll see how the lawyers figure all that out. But, the whole AI thing is this very complicated and interesting development going on. And we'll do a module on that and revisit that subject from time to time. But NVIDIA is right at the center of it. And if you want to learn, one of the ways I plan to learn about AI is to actually read some of those NVIDIA like annual reports and quarterly reports, at least parts of it, to try to understand kind of what they're doing. But they're sort of right there at the cutting edge of it. And I'm sure reading Google, one of their annual reports or quarterly reports is going to be very informative as well in terms of the applications of AI and how they are using it. So if you think of NVIDIA as the chip company, Google and Microsoft and others are building these AI engines, and Microsoft. Obviously, we probably all use Copilot from time to time, and there's a lot going on there. So more to come on that. Is more investment coming to the U.S. from foreign companies? So the latest data through Q1 doesn't indicate more inflow. You've heard Trump bragging about these giant numbers, 17 trillion. These giant numbers of investments coming in. He's looking at estimates over a number of years. He's not saying we actually got 17 trillion in cash, although maybe he's confused, but unlikely. It's just the data through the first quarter doesn't show more of that inflow yet, but that data is readily available. So I'm going to show you some of it here in a minute. This is foreign direct investment in the United States. And so these are annualized numbers. This is in billions. So it says millions of dollars on the side. If you get rid of the last 3 zeros, that's how many billions it is. So about 292 billion annualized in foreign direct investment in the United States. Now, this number, there's a definition of it above up there. It doesn't, there can be other kinds of investment in the United States, like if you buy stocks, you buy bonds, that's different from this. Foreign direct investment means coming in to get a significant ownership stake of a large company. And that is not changing. You can see kind of it's sort of, it hasn't really jumped dramatically in that. It went up in the last quarter, but it's sort of in this, fluctuating range. I wouldn't say that there's an upward trend yet. But we'll see, and if Trump is telling us that there's 17 trillion coming in and this is 292 billion, then you're going to see these numbers getting much, much larger. But I have to look further into what are some other like portfolio investment, US stocks and bonds. I got to look to see how much more of that is happening. But Trump is more referring to this sort of thing, buying plants and equipment, investing in our businesses. It's not just talking about sort of passively buying stocks like a mutual fund or something like that. That we would hear it if there were giant inflows there as well, but I've seen nothing in the news. I just have to go look for it. This is another way of looking at the one I showed you was how much it is changing, quarter to quarter. Here is sort of the summary of it, meaning this is how much total has been invested by foreigners here. If you're an accountant, we're talking about the balance sheet. Here's how much dollars foreigners cumulatively, that's a better word, cumulatively have invested in the US. And so it's about, these are the different entities here. I should have written down how much all this was, 5.7 trillion. And Europe actually are the biggest ones. It's not Asia, it's not China, although they have a big chunk here. It's the Europeans actually that do a lot of the investment here in the United States in terms of ownership of corporations. So there's some stats here. Let's see. Big increase, 204 billion in the position from Europe. Interestingly, 52.9 from the United Kingdom and 39 from Germany. People always talk about the UK as being on its deathbed in terms of an economy, but here it is, busy investing in the United States. And then by country of the foreign parent, 4 countries accounted for more than half of the foreign direct investment, FDI it's called, not to be confused with the FBI, FDI, foreign direct investment. Japan was the top investing country, followed by the UK, Canada, and Netherlands. Interesting, the Netherlands is such a big one. It's such a tiny little country over there, but they got some money apparently, and they are investing it here in the United States in our businesses. Now we had this gets into some very complicated stuff. We had questions around the trade deficit and understanding that, and again, we're due for a full section on that. But we talked about this idea of a trade deficit being vendor financed, and if this stuff gives you a headache, you're not alone in that. It is complicated. It's tough to visualize, so I created this little diagram. It's very simplified, which is about as far as my understanding goes, at least at this stage. But let's follow this logic through and kind of try to understand this idea of a trade deficit. So the US wants to import some Chinese products, so Walmart wants to get a lot of the stuff that it's going to sell. So it pays dollars to a Chinese exporter. And I thought going into this that we had to sell dollars to buy Chinese currency, the yuan, but it turns out I was wrong about that. Most of this trade is denominated in dollars now, it was just interesting. Has some other implications I won't get into here. Now the dollars then go into the Chinese banking system. Those companies that the Chinese importer or the Chinese exporter that gets the money deposits it in their bank account. The China invests that dollar, then China needs to do something with all these dollars. And what's it going to do? Well, it's going to buy US assets like treasury bonds, stock. It's going to do foreign direct investment maybe. And so the dollars come back into the US banking system. And then the US importer is going to borrow those dollars to buy Chinese goods. So you have this sort of circular thing of the US is borrowing essentially from China, borrowing dollars from China to buy China's stuff. And so when you hear a trade deficit is vendor finance, this is the mechanism that we're talking about. I'm looking at the bullets over here to see if there's any additional info I want to give you. All right, so this fourth bullet, this idea that a trade deficit is adding to the US private sector debt, other things equal. If we are importing stuff more than we're exporting. If you think of an import as something we're spending on, right? We're buying those items, and an export is our income because we are selling stuff overseas. If we have a trade deficit, we are spending, we're giving a lot more money. We're getting stuff, but we're sending money net overseas. And where's that money coming from? China is lending it to us to do that. So we get in more and more in debt. And so it isn't just the treasury bills. You see it in private debt. So a lot of corporate bonds and other things that are being issued. The private sector goes further into debt to finance that trade deficit. China is the lender. The US is the debtor. Complicated, nothing simple about this. But that's kind of one way of thinking about it. And this is part of why Trump is very opposed to a trade deficit, is he's saying, it makes us debtors. And on the other side of that, and let me see if I don't know if I included the diagram here. I didn't, but I will in a future meeting. When the government is running a budget deficit, it is lending also to the private sector. So that money is getting injected into the private sector, and some of that money gets used to buy Chinese stuff. Some of it is used for other purposes, so that those households don't get into as deep a debt. So if you think of the trade side of the equation as making households poorer or putting them more into debt, the government injecting that money, the government going into debt is actually kind of bailing out the private sector to some extent. So this is the sector balances. We go through all those about once a year, so we're due for that. But the Trump is not crazy when he says, there's some threat from all this international trade. On the other hand, it's not a crisis. It's something that, as long as the government is willing to run a significant budget deficit bigger than our trade deficit, the private sector can get richer. In fact, it must, by sort of accounting rules. Again, it'll be easier when I show you that and we talk about the sector balances again. But this, as long as we're running a sizable budget deficit, we don't really have to lose sleep over this. If we were to balance the budget and run a large trade deficit, you would see the private sector getting a lot poorer. And then you get into trouble. And that's part of what happened with the Great Recession. It's very complicated, so people don't often think of it that way. They blame deregulation or failure to regulate, most likely, actually. But there are many other factors that are more subtle. One of them being when you run a large trade deficit, but you don't help out the private sector with a big budget deficit, a government budget deficit, they get poorer, they get much more indebted, and bad stuff happens. The Federal Reserve, and this section is sort of miscellaneous stuff, so I'm going to start jumping through miscellaneous stuff here. The Fed has not just the interest rates, which it's going to likely lower tomorrow. The Fed maintains a giant balance sheet. Now, what does that mean? The Fed owns a ton of bonds. They're government bonds. There are housing bonds, some private sector bonds. They don't own stocks. That's not what they own. They own bonds from corporations and others, but it's mostly housing bonds that Fannie and Freddie have issued and government treasury bonds. I'll show you a breakdown of this someday, but what this is showing, though, is that the Fed expanded its balance sheet dramatically, and then it's been contracting over the past couple of years. When the Fed is doing this, expanding its balance sheet, what does that mean? It is buying the bonds from the private sector. It is giving money. It is injecting money into the private sector and taking the bonds out of the private sector. So this is boosting the economy. And when it's doing the opposite, when it is reducing its balance sheet, it is selling those bonds, taking that money back out of the private sector. So the bonds are going into the private sector, the money is coming out, and the Fed is sitting on it, or who knows what they do with it, burning it. I'm not sure what they do with it. It's not paper, but retiring it. It is sitting. They have been reducing their balance sheet, and so this has been slowing the economy. So the Fed, even though the interest rates get all the attention and Trump goes nuts in the news about the interest rates, the Fed has quietly been selling its bond holdings and therefore slowing the economy over time. And so this is a big tool. This is a powerful tool that they have to do this. It is not just those interest rates. So just keep in mind the Fed has been, they use the word tightening as opposed to loosening. This is loosening here, tightening here. They are tightening up financial conditions. They are keeping those interest rates a little bit higher. And that people are, they may reverse this, but that has also been slowing things down in the economy. It's just more subtle, trying to explain the Fed balance sheet. You heard what I just went through. Your average person on the street does not know the Fed balance sheet from Adam, but they know what interest rates are. Now, here's a little coming back to that bankruptcy idea. We just don't see it in the data yet. So this is a little bit of detail there. 2025 is green here. So it's a little bit higher, but it's, it's not crazy high compared to the blue, which was last year, 2024. It's a little bit higher than these older years. But in terms of, do you see a trend upward recently because of tariffs? I don't. If you do, great, but it hasn't been really. That green line is not moving. If we see that green line start jumping, then we know something's up. In terms of, let's see, we're at 8:02. Let's pause there. And Carl and I will look at the questions and think through those while we're on break. Let's come back at 8:10 or so. Does that make sense, Carl? 8:10?
Sure.
All right, and we'll see you guys back then. What have we got, Carl, in the queue there? And actually, I can look now too, I guess. I heard a lot of activity going on, so I know there's something out there.
I don't know what that says. People coming in and out of the.
We scared them. No, we still got most of the crew is still here. We'll lose a bunch at the break probably, but. All right, let's see. We had some stuff about food prices jumping. We covered that with inflation. We don't have a lot of that. It wouldn't surprise me if we have some locally or in different places or on particular items, but overall, food jumped just this past month, but for the last few months before that, it hasn't been that bad.
Eggs have come down over the last 6 months to a year, but ground beef and beef prices are way high.
Mm-hmm.
But I was seeing that somebody has, and I don't know whether it's Jewel or Mariano's, whatever, has got their skinless, boneless chicken breast for $1.49 next week. So starting tomorrow. And we've got Anthony Stuckey with his hand raised, so he has a question for us. And if he wants to come off mute and ask his question, we'd be happy to address it.
I don't have a question, actually. I joined late, but I did want to say thanks for the sectoral analysis part of the foreign direct investment and government spending numbers.
Sure. Yeah, learning about the sector balance was really one of the coolest things I picked up in the last decade. I really enjoyed that, and we'll do a session on that. It's really a fascinating idea.
David and Carl, will you be taking questions at the end of the presentation at all?
Yes.
At
Okay.
the end and during, we take them anytime. Yeah, we try to do it by section. We went through the sections really fast today because everything's perfect in the economy. Everything's going just fine.
I was going to say, in case we missed anybody's questions, I was going to ask them to raise their hand at the end of the presentation, unless you would like it beforehand.
Yeah, beforehand's fine. We're good on time. Yeah, we've got a question from Penelope Bingham. It's interesting. It's on some deporting statistics about how many people have been deported. Got to take a look at that. Let's see, how does this affect the employment numbers? Are deportations explicitly recognized in official numbers? And they definitely are. But they're not as deportations. That isn't like a statistic. It's going to be how many people entered the labor force or left the labor force. It's going to be subtle how it shows up in there. You're not going to see deportations as a specific number in, say, the BLS surveys. But it is going to show up in the employed and unemployed and all that stuff that you will see it, or the size of the labor force, which I think Carl shared one of the slides in there that showed the labor force has been flat since Trump started. You know, our population is growing, but the labor force has been flat because we've been kicking out immigrants. So that's kind of where you see it for sure. All right, let's see. Yeah, we had some AI questions on, is that going to affect jobs? It will someday, but it's unclear what direction. I mean, historically, every time there's sort of a new technology, the number of jobs goes up, although it displaces people in certain industries, you know. So it's a question of where it's going to affect people, and if the AI related jobs are enough to offset that. Like it takes a lot of people to build a data center, a lot of construction workers to build a data center. Is that going to offset, you know, a bunch of office workers that get fired because AI can do their job? You know, I don't know. We don't. Nobody knows. I mean, everybody's guessing, but you can kind of start to think about what are the things that where would jobs go up because of AI? Where would jobs go down? And you know, I'll leave it to pro economists to do that, and we will share their reports when we have them, or their forecasts as they come in. Isn't the trade deficit based only on tangible goods? I seem to recall reading it fails to include income from services. No, that's not true. You can split them out. The trade deficit, there is a goods trade deficit, but there is a services trade deficit as well. And when people talk about the trade deficit overall without modifying that, they're talking about both. But yeah, you can actually see in the census data, it'll tell you imports, exports of goods, imports, exports of services, and the total. You can actually see it. So somebody replied, yes, services are not included. I would say that's not quite right. Services are included, but unless they're just talking about goods on purpose, then, so Nora may be correct in her response. If the question is, are we talking goods, then services are not in there. But in the overall trade deficit, yes, they definitely are. And the U.S. is usually a net exporter of services. It reduces our overall deficit when you add in the services. Will the cost to buy a house go down over the next year? Carl and I are famous. We put on we get our crystal ball out. No, we try not to forecast as much as possible. If you hear us hedging about our forecasting, we do it on purpose. But you know, housing price, we can tell you from the data, the housing prices have been coming down, right? We showed you that chart that said housing prices have come down quite a bit since 2022. Will that continue? One thing is most likely true is if interest rates fall, and they likely will, at least somewhat, assuming they fall, it will be cheaper to buy a home in terms of the interest. You know, I showed you that mortgage chart. It'll be cheaper. Your monthly payment will be less, but I can't guarantee you that house price is going to be much lower than it is. There's no way. I don't know.
I'll tell you, my brother is hoping houses prices, the cost to build a house goes down, because he's got a multi-level house in the Cleveland area, and he's retired and struggling with stairs, and they want to build a single story house.
Yeah.
But whether it's going to be good for him or not, who the heck knows?
Yeah. I got one of those chairs for my dad when he lived with us for a while, when he was getting toward the end. And they're like, if it's a straight shot up the stairs, it's like $7,000 for one of those things. And if it curves, it's basically double that. So if you've got a curved staircase out of your first floor or basement, you're looking at like $14,000 to buy one of those things. And I don't know to what extent it's covered by insurance. I don't recall that it was.
But it still might be cheaper than building a new house.
It was painful, no doubt. Yeah, it's not, as far as I know, covered by Medicare. We had a point here that median sale price of a house in Seattle in August was $885. It's a great point that real estate is rarely national. It's mostly local. You know, what's going on up in some places, down in others, definitely. Now, somebody picked on us for using Trump's terminology and spreading his messaging. So if there are specifics, we would love to know, because we don't do that on purpose, although
well, I think I use the term one big beautiful bill because that's what the official name is.
Yeah. Okay, now that Carl is allowed to do that. We're using factual names. Trump is just, but be aware of it, how good they are at branding stuff and using slogans and everything. It's something we can, I think, learn from Republicans, as they do a great job of that stuff. All Let's see. And Carl, did the Democrats come up with any catchy pushback on that? The OBA, did we come up with any catchy names for that bill?
Oh, I think people have called it the, stupid bill, among other things. One big ugly bill. But again, it's sort of like the Affordable Care Act was called the Affordable Care Act.
We got a question about how a farm bailout will affect the economy. I mean, it's stimulus. So if they put another $50 billion bailout in there, I think that's a lot. It was like 28 or something the first time. So whatever it is, 30 billion or something, it's going to help those farmers and boost the economy a little bit, but it adds to the deficit, like anything else. Do I have a website? This is my website. It's these guys right here. You come to this meeting and that's where we talk. No, at the end of the presentation, I'm on Twitter and I always forget the name. I am terrible. What is the blue butterfly is?
Blue Sky.
Thank you. Jeez. So I'm on there too. So you can see if you're interested. I tend to mostly just share stuff on the blue site. And I tend to get into arguments with people on Twitter. So you're going to get more noise if you follow me on Twitter. But the blue stuff is mostly just sharing kind of economic data. Do we give Zoom presentations to other groups? Is there a fee? Carl and I do not charge a fee. We enjoy doing this stuff. If you ever need us to speak somewhere, let us know. We'll consider it. We usually would charge pizza money. Very important that we get fed at these events. Otherwise, we're pretty good about that. Let's see.
You're going to show up for in-person pizza night?
Someday. I heard COVID's having a resurgence right now, so I may be hiding out for a while. Yeah, it's coming back, sadly. Yeah, it's a good time to be careful. So Ken is definitely a guy who does not like it when Trump's words are repeated. So Ken, we hear you. Keep us honest. If we start talking in Trump speak, you let us know. All right, I'm going to share my screen again.
Right, but to speak to the point of this meeting is not really intended to be political, right? It's about giving real data from real sources. And in this particular case, you probably should be using the actual name of the bill.
And what is it? It's like a crazy reconciliation name, isn't it? What's the official name of it? Does anybody know? Chris is raising his hand, or Dr. Chris Welby, or she.
Yeah, Dr. Chris Weldy is a she.
All right, excellent. My bad, sorry.
No worries. I did put in the chat the official name. So Chuck Schumer actually proposed a modification right before the bill passed. I think it's just right now officially something like the Act, which wouldn't resonate with anybody. Even if we wanted to be just safe, we could just say budget reconciliation bill, and then we don't put any spin on it. If we're talking among friends, generally we say big bad bill, just to emphasize that it is not a beautiful bill. But anyway, but it's in the chat for you.
That's a deal. Thank you. Now that makes sense. Yeah, the budget reconciliation bill is a good neutral way of describing it. All right. Can you guys see, Carl, can you see my screen? Did I do it right?
Yes.
All right.
Yeah.
So we will resume. So feel free to eat and chow down. I was eating during the first part. So since Trump has started, when you look at some of the key financial measures, so this is the number as reported in January and the number reported in August, just comparing them. These are monthly averages. So the stocks is not for a particular day. It is how the Federal Reserve data, Fred, I got to put that source on here, but it says where it was on average in January, where it was on average in August. And so stocks are up 7, hourly wages are up 2%, 2.1. And then the inflation so far in the main categories, or some key major categories, is below that, meaning people have more purchasing power, which is a good thing. The wages have outgrown the major measures of inflation so far under Trump, and they were doing that as well during much of the Biden administration. But this is the, well, I would say the back half of the Biden administration, 23, 24. But this is good news for the most part. Let me click over here. I think I have that slide. Let me go here for a minute. Do I have it? I took it out. I was getting to so many slides. One thing I will tell you is that a lot of people, at least if you read it in the news, a lot of people said we voted for Trump because we wanted prices to come down and that he would lower prices. Prices overall, on average, when you compare like year one to the next year, since 1948, there have only been 3 years when that happened, when the overall price level fell from one year to the next. Only 3 years since 1948. The biggest year was 1% in 1949. In other words, prices falling isn't a thing. If you vote for somebody thinking the prices will fall, you are not making sense. It is not a thing. Now, if you mean you will lower inflation a little bit, then that's different. And yes, that's a legitimate reason to go for somebody. If you feel inflation is high, you think they'll be lower. However, it was widely publicized before the election that Harris was the low-cost option, meaning that inflation would be lower under Harris than Trump. Those of you that come to this call have heard me say it a million times. I don't think this election was about economics, but I'm in the minority on that view. But if you look at it logically, tariffs would create higher prices than a no tariff scenario. Harris was the no tariff scenario, and prices do not fall. They just don't. I mentioned the history there. So if you were voting on prices, you would have rationally voted for Harris. So either we have an irrational electorate. I'm not saying everybody's Spock, and they only acts on logic. But, it was pretty clear if you were paying attention that Trump was the higher cost option. And one of the Fed chairs said that the inflation rate is about 0.3 higher than it would be without the tariffs. When you go back to before the pandemic and you kind of look at how things have progressed since then, because there's a lot of distortion from the pandemic in 2020 and 2021. So it's nice, I think, to take a clean shot and kind of see where have you come from before the pandemic. Tremendously, people have done incredibly well. The net worth of the bottom 50% has basically doubled. The stocks have basically doubled now. The net worth of the 50th to 90th group, up 55%. Home prices, 48. GDP nominal, 37. Hourly wages, 30. Inflation, 24%. So all of these things have far outgrown inflation. On paper, people are way better off than they were. And Carl mentioned earlier, we had the record real median household income in 2024 at about 80,000 and change. So there is a lot of good news about the economy. The bad news is, Trump has thrown some dirt in the gears, so to speak, or the image that I've given you guys. He's doing a little sabotage that's slowing things down. But, in general, the over the last, during the Biden era, basically, the recovery from the pandemic, households came through it very, very well. And, that's part of why this economy just has continued to surprise people and not gone into recession, people are in tremendously good financial shape. And here's one way of looking at it. These are a lot of different measures of household financial position. Economists are starting to use this. I see it more and more over the past couple of years, sort of this idea of trying to take the noise out of the GDP figure, because you get tariffs causing big swings in imports and exports, mostly imports. You've got inventory investment that tends to fluctuate pretty widely. And so if you take that stuff out, you get something that looks like this, which is the sum of consumer spending and gross private fixed investment adjusted for inflation. This is real final sales. They call it real final sales to private domestic purchasers. It's an awkward name. But my takeaway here is growth was sort of on this 3% range for quite a while. All of 23, 24, last couple of years was sort of fluctuating in this 3 range. And now it's down here in the 2 range. And I think that's accurate. That makes sense to me in terms of with all the, the putting the stick in the spokes, as I was showing you earlier, all the different things, the tariffs, the immigration restriction, the firing of federal workers, indirectly the attacks on rule of law and the uncertainty some of these policies have created. It doesn't shock me that the economy has slowed from 3%-ish to 2%-ish, and we see that in some of those forecasts from the forecast that Carl showed earlier from the Congressional Budget Office. Now, this will likely, hopefully, reverse and start to pick up as these tariffs aren't really being increases in tariffs anymore. They will be the steady state. And so they won't be as big a drag here. But my view, and you've heard it before, is if you don't have immigrants, nearly all the jobs added net during the Biden era were immigrants. If you don't add them, where are you going to get growth in your economy unless people become unbelievably productive, right? If you have the same number of workers, those workers have to generate a lot more output each. That's productivity, output per unit of input. They have to be incredibly more productive. Is AI going to drive that? It could take a decade for that stuff to really filter in and make a big impact in business day to day. The internet didn't do it overnight. And so we'll see what happens, but it's really difficult. And also with the aging country, you've got about 4 million plus boomers turning 65, and a large number of those are retiring every year. Not necessarily, again, that first vintage the people that just turned 65 aren't necessarily in, but the people that turned 65 last year or 2 years before or 3 years before, you're seeing a large number of retirements. And, how are we going to maintain our workforce is kind of the mystery to me. I look at the immigrants as the big issue. As much noise as tariffs get in the news, the immigrants to me are the bigger issue. This is a lot of spaghetti, but the idea is to show you that if you look at that dotted black line down the middle, that's kind of the starting point, 100. The NBER, the National Bureau of Economic Research, that's the group that calls when recessions start and end. They're the business cycle people. And they have said these are the 6 measures that we use to help us just determine whether the economy is going into recession, if we've hit a peak or a valley. Hit a peak meaning we've passed a peak and the economy is going down, and that means we're in a recession, or at the bottom, we're now in an expansion. The recession ends and we're now expanding. 4 of the 6 measures are now above the black line. And the black line, this starts at March of 2025. So about when the tariffs went in. For a little while, 2 of them were we had 4 below the line, like right here in June. Purple, green, this blue, and this blue were all below the line. But we've had this recovery here in the real personal consumption expenditures, the purple, and the blue is the real personal income. So these measures of kind of how the households are doing and how they're spending, income and spending, have kind of reversed and are going up. Now we'll see if that's a trend, but that's good news for households. And it tells you that it's unlikely that we're in a recession now, because we would see a lot more of these lines dropping. We would see a lot more under the black line and not going up like this. But it was starting to look a little scary there for a while. If you kind of follow from here down, sort of see this cluster of lines going down, they've since reversed. So we'll see, if NBR spotted something here I didn't see, but until you see negative job creation, it's kind of hard to really say you're in a recession. I mean, it's usually that is what you're going to see as sort of the no-brainer that you're in it, is when you start to see a few months of negative jobs. And we only had the one. June was minus 13, as Carl pointed out earlier, after the initial adjustments. Pardon me, a cough here. All right. We're getting there, almost done. Violent crime. Get a lot of noise in the news about that. Lowest in 20-something years. The violent crime rate per 100,000 people. It peaked up spiked up in 2020 with the pandemic, and then down. the years after that. This is FBI data. It's the best data we got. And this gets at the law enforcement officers. So I was trying to answer the question of, did we have a stronger police presence under Trump or under Biden, a more intense police presence? And you could get the data of how many law enforcement officers there are, again, from the FBI, same source, per 1,000 people. And it turns out that Biden, from 21 to 2024, there were about 3 officers per 1,000 people, 3.5. And under Trump, it was just slightly below that, 3.44. So we actually had more intense police presence slightly in the last few years. And in terms of officers added, on average, this is not on average. This is from the beginning to the end of the term, that many. And then how many officers were on average during the administration? Biden averaged about 100,000 more officers than Trump. Now, the point I'm trying to make is when you talk about soft on crime or, trying to control crime, Biden had a more intense police presence than Trump and better results in terms of the violent crime per 100,000. Now, I should also add that correlation is not causation, a famous saying among statisticians and data nerds. Correlation is not causation. Just because you have a more intense police presence doesn't necessarily mean that was the cause for this, but it's as good a hypothesis as any. And so I will stick with that for now. You will also, and I apologize to people that see this every month, but I always say it because we have new people and also because I think it's super important. People will try to scare you that the national debt is a crisis and that we're going bankrupt as a nation and we're going to collapse. So there's this nihilistic narrative out there, and it's part of that, their planks, one of their many things that they say a lot. And the household net worth in the US, so assets minus liabilities, is 160 trillion. And it's very concentrated. The top 10% have about 70% of the wealth, 108 trillion in just the top 10% group. The bottom 50% has very little, only 4 trillion of that. This 36 is now 37, but this is as of the end of the first quarter. Any day now, and I have to check because it may have come out, we're going to get the net worth data with the split for the second quarter. We just have the total right now. I have to look, but I think it was up a little bit. But I saw a nominal number. I want to adjust it for inflation, but I think it to see how it compares to the past. But it's like, I think this number is a little higher than this now. So we're not going bankrupt anytime soon. And we've talked about this before, but the US can't default the way like a household can go bankrupt. The government can always print the money. If the legislation says make the payment, the government will find a way to make the payment. Doesn't need to have all the money somehow from a tax dollar in advance. You can generate it. So don't lose sleep over this. I think to a great extent, rich people that control our media, and I don't mean that as a conspiracy theory, they flat out own the papers. They want us to kind of think that they want us to be scared by this national debt so that we are okay with cutting spending. And an enormous amount of the population buys into that idea. They don't go through this lecture for me. We have the money. And even if you were able to get 1% a year out of the top 10%, whether you did it with a net worth tax or traditional methods, just jacking up tax rates, whatever you do, eliminate their tax expenditures, which are deductions, exemptions, all the stuff that the lawyers help them get. You get rid of all that and you get $1 trillion very easily, which makes the deficit not problematic for a very long time. And these people will still get richer. If you take 1% of this a year, they're still going to get richer. Stock market's up. It doubled since 2019. They're doing okay. They will not be poor because we tax 1% of their net worth. However, we get it. All right. So just to wrap up, if you're wondering what you can do, there's a lot of different organizations that you can contribute to. Act Blue is sort of a clearinghouse for a bunch of different ones. You can write your senators and others. You can do that right on their website. It takes like 2 seconds to do it. If you are organized, you write your own Word document, what you want to say, and you can send that to dozens of these people in a matter of an hour or so. Just you cut and paste that stuff right into the message. You put "Dear Senator so-and-so" at the beginning, "Sincerely so-and-so" at the bottom, and you are a machine in terms of getting that stuff out. So whatever you want to say, you can get it out easily. newspapers, I love to comment on the New York Times and other places, social media. And then Indivisible has got their Take Action Now website. So there's stuff that you can do from there. There's the 50, I'm going to spell it wrong if I pronounce it wrong, 5051 initiative. They do a variety of things. So you can get out there on the street. I think Bill may have to help me here. Bill, isn't there a big day coming up? Is it Indivisible or
Christina's bill still
do you
not,
might know? There's a big March day coming up, isn't there? Or some kind of anybody want to talk about that? Maybe not. I thought there was I saw
There's
something in the news.
There's another No King's Day coming up.
Okay.
yeah, October 18th.
Yeah.
All right. So we'll be marching. There's some just a picture of the site of Act Blue. It allows you to get to a bunch of different democratic organizations and people. I always tell people to share this, get the word out. 10 of the last 11 recessions started under Republicans. It's part of why the economy does so much better under Democrats. It's not close. About once a year, Carl and I do the full spiel we go through 15 slides on why Democrats are better for the economy. Republicans are not even in the same league. They are minor leaguers compared to the Democrats, what we deliver. And 51 million jobs since 1989, 50 million under Democrats. Even when you start playing with these numbers and adjust them, it's enormous, like 3.5 times as much job creation under Democrats. Even if you make Democrats look bad, like you take away a lot of the Biden jobs because you say, well, those were recovery jobs from the pandemic, fine, okay. It's 8 million, okay, give a few of those back to Trump, doesn't matter. We're still gigantically ahead of him. Here are some sources and links that you can find for some very helpful data on this. Democrats way better for the economy, a bunch of sources on that. The bill, HR1, we could call it HR1 if we want to be subtle about it. The Yale Budget Lab is doing great work, by the way. Let me do a quick pitch for them. His name is Ernie Tedeschi. He worked for the Obama administration, I believe. He is the guy at the Yale Budget Lab. He does great stuff. He's a great guy to follow. On Twitter, he sticks to pure economics. He doesn't get involved in a lot of other noisy arguments like I do. But the Yale Budget Lab updates kind of the impact on people from the tariffs like every couple of weeks, or every time Trump makes a big change, they update their analysis quickly. And we've shared that in the past, like last month or the month before, we shared a lot of Yale Budget Lab stuff. And you go out there, you're going to be surprised at the good content that you can find. And it's put in a way that is pretty easy to understand and pretty easy to cut and paste into, into your social media or wherever else you want to share it. And we're due for a module on immigrants as well. I mean, the Carl was mentioning how there were 2 open jobs for every unemployed person for a while in 2021, 2022, maybe even into early 23 before that number really started coming down. We filled them with immigrants, in part because of our aging demographics, in part because the economy was just booming. We didn't have enough people. And so we surged in a ton of immigrants. It was perfectly timed and the economy just rocketed. And this Congressional Budget Office did a couple of studies, one that talks about how big an economic impact that surge is, about 65,000 per household over a decade of extra GDP or income. And then also a big deficit reduction of almost $1 trillion. And they also talked about conservatives are dialed in on the cost of the immigrants. There's a study on that, which shows that the state and local budgets, which is what people are usually complaining about, very minor impact and really minor after the revenue that's coming into the state from these workers that are there. So, if your view of immigrants is you just don't want brown people here, I can't change your mind. I can't go there. But if your view is immigrants are a cost to us, and so I don't want them here, that is factually wrong. Immigrants are a giant win economically for the United States. And it's not close. It's huge. So you can learn more about that from there. And CBO is the best source we have. There is nobody that carries more weight than the CBO in this kind of analysis. They are the most definitive source of analysis you can get. They advise both parts of Congress, not just the Democrats. They advise everybody. They are run by a Republican, and they do a fantastic job. This is just a chart I saw today. I just threw it at the end. You guys don't all have this chart. Just happened to put it here because I want to use it next month. But interesting chart from Mark Zandi, who's a guy you should follow. Mark Zandi, Z-A-N-D-I. Moody's Economy is his thing. And also a guy who sticks with the facts on the economy and his best estimate of what's going on. What he's saying here is that for the bottom 80%, spending has basically kept up with inflation. People have not bought more than, it's really just, they're just keeping up. They're not buying a lot more stuff. But these guys, the top 20%, and so the light blue line is the top 20, I'm sorry, the green line is the top 20%. The blue line is a subset of the green line. It's just that really top income people have bought a lot more stuff. They are buying a lot more stuff. They have far exceeded, their spending is way above inflation, meaning it isn't just the pricing part that's being absorbed. They are buying a lot more widgets. And this is what has been driving our economy. So I thought this was a really interesting slide, that it's really the top 20% that are really the engine, and the other people are sort of, the rest of us, the 80%, are really sort of just keeping pace with our spending. So that concludes the official presentation from us, and let's take some questions. We made record time. Carl, is this like our fastest ever?
Yeah, maybe not, but it's
Pretty
probably
close.
the fastest in the last year or two.
Yeah, we are lean and mean to this time because we didn't get into the tariffs. They're complicated and there's a lot going on there. We didn't deal with that as much. We didn't get into the budget stuff. So we'll catch you up on the budget next month when we get the full year has come in. So let's look at the questions. Just looking through the chat for anything. If people want to ask questions, raise your hand while we're digesting some of these things.
Or just shout them out.
Yeah, go ahead. This is the informal
Please.
part.
Raise your hand. Oh, Linda's got a question. Hold on one moment. Okay, Linda, how are you?
Remember to unmute.
Unmute. Yeah, there you go.
Yes. My question has to do with the large AI centers that are being built and the health implications around those. You know, being a healthcare provider, I'm very concerned about that. And if you could please address that.
Well, you may be more of an expert than us on that. Tell us what you've been hearing.
I've been hearing that it's going to cause a lot of physical ailments, from respiratory. Well, actually, many of the folks in Tennessee are already suffering. So they are developing blood dyscrasias, blood diseases, as well as respiratory issues.
And this is from the data centers being built? Is that what you're thinking?
Yes, and around the Memphis, Tennessee area.
All right. We will look into that. I'll have to learn more about that, but thank you for bringing it up.
Thank you.
And we will call on you. We may call on you to answer the questions next time, so beware, be ready.
All right, thank you.
Yep.
Anthony?
Anthony has a question. Go ahead, Anthony, unmute. Thank you.
No, I was going to respond to that. Quite often the data centers are built with natural gas power for emergencies. And whenever that gets invoked, you get the usual downstream carbon problems. So yes, there's definitely something to that there are health effects around data centers. And I think the noise is also an issue. Because it's well known that simply being in noisy environments causes a variety of stress and heart attack kind of issues. And so when they fire up and you get that 90 decibel generator screaming across the city, people notice that.
Okay. Thank you so much. We have a question from Dana. Go ahead, Dana, unmute.
Actually, it was also a comment on that. I haven't done any fact checking, but I think it was the one in Tennessee. I read that it was being run mainly on gas generators. One, there are huge went to Lobby Day with Sierra, and that's over a year ago. It was spring 2024. And one of the concerns about it was the huge power consumption and whether that they require and just the build up, whether some of the cost of the infrastructure to provide the power to those facilities was going to end up going back, besides all the environmental issues, whether it was going to end up going back on the regular Joe Blow consumers, because apparently it takes massive amounts of power. I read something that I didn't fact check. I thought Musk had some relationship with the one in Tennessee, and that it was running mainly on gas generators. And that may be that if he was, pushing pedal to the metal and getting it online fast, that he did that rather than wait for the power infrastructure. But that's a little bit of a guess.
Hey, thank you, Dana.
Deb Martin.
Yes, we have Deb Martin.
Yes, I was wondering what would be the effect on the economy if we have a shutdown?
And that's going to be interesting. Carl loves these things. This is his favorite.
Well, I don't love shutdowns, but I do think that it will not be a positive effect on the economy.
Yeah.
It will increase the deficit in the near term because you typically put federal employees on hiatus, and then when they come back, you have to pay them their lost wages to bring them back. And I think that it's generally not good, but exactly how much the economy gets shut down and for how long will impact how much the economy gets hurt by a shutdown. And with the end of the fiscal year coming up September 30th, of course, that's October 1st would be the deadline for a shutdown if we don't get appropriations bills, or at least some temporary things. But also by the middle of October, we should have announced what the fiscal year 2025 deficit was.
Okay, hope that answers your question, Deb. Thank you. Hello, Mr. Larry Clark. Unmute, please.
Hello. I don't have all the answers here, but I think you'll find that the data center in Memphis or South Memphis is Elon Musk is Colossus, which was named after a science fiction computer that took over the world and maybe killed everybody. But the problem there so far was he exceeded the number of giant gas turbines to power the place. So he was breaking the permitted laws that they already had. And I think it might be in an area that is kind of abused along the river as far as what they do there and what kinds of things are expelled. So that's my best story. Thank you.
Thank you, Larry.
That's a couple people have asked about that, so we'll research this and bring a few slides on that next time. I know that one of the things we've been seeing is the costs of electricity have been going up. And let me go back to one of the slides near the beginning, just so I have the facts in front of me. You guys have the presentation. It's a slide number, where are we here? Slide 28. Let me think here. It says that electricity is up 6% over the past year. Utility pipe gas service up 14% over the past year. So energy services overall up 8%. That's a lot. That's a lot more than regular inflation. So if the data centers are competing for power, then you know, you will see that. And I remember somebody talking about the hours are different, like a lot of utility power is given or provided during certain peak hours. And that a lot of what it can be done at data centers can be done off peak or is done off peak. So there's some mitigation from that, but I need to dig into this because this whole AI thing is going to be a giant set of issues that we'll be dealing with in this is a good way to look at it is the data centers, the investment around the data centers, the environmental impact is interesting. You know, there and the fact that it's starting to drain resources, water or power, as a couple people have mentioned, there's a lot of good stuff there to wrestle with.
Okay, Linda has her hand up again. And I can tell you my electric bill has gone up over $100 from what it was.
Wow.
Yes, so. Okay, Linda, I need you to unmute.
Oh, I was going to respond to that. I was just going through my mail and I just got a notice today that said my energy bill, my electric bill was going to be going up. And then it broke down the peak times and what the rates would be based upon what time of day I would be using it and approximately what my usage rates would be. So I've already received that notice. So I just wanted to share that with you.
Okay, thank you, Linda. And yeah, mine started in August. So thank you so much.
We're gonna get a healthcare shock too coming up pretty soon as well. So I'm looking
Yes.
forward to that. We got to do some work on that.
Okay, Cecilia, go ahead.
Oh, yeah, just the 220 data center facilities spread mainly across Chicago, its suburbs and select towns and broader metro region. It looks like y'all definitely are the metro center of where it is, and that the projected residential bill increase is $10.50 a month, with projected ComEd bill increase of 8.3% but I'll put that in the chat.
Thank you.
You're welcome. That's from 2025 to 2040.
And who have you got there? Who is your furry friend?
Oh, that's Ruby.
Yeah, she's going to show up. She's got to at least wave to us.
Yeah, she does like to make herself known, doesn't?
Excellent. Good for her. Thank you.
Mm-hmm. I do not see anybody else's hand up at the moment.
All right.
Should we wrap it up?
Yes, let's get the record while we can, or close to record.
Hold on, David.
Oh, we have a hand up. We have a hand up.
Uh-oh, darn it.
Robert, go ahead.
Hi guys, thanks a lot. I was gonna write in the chat about this Illinois Shine program for solar panels on your house. It will be ending at the end of the year or in the first quarter, and they're really giving pretty good breaks for anybody that has a home. And you get a lot of credits, and you can now produce 175% of your usage, and the solar collection will be, oh, I forget what they call it. Somebody knows here. Net metering. So it's Illinois is trying to stay good on the ecology, on the Paris Accord, best of my knowledge. And my panels are up. I'm still waiting for them to be online. It should be a couple more weeks. So it's going to balance my bill.
Good idea.
Do you have a link for that by chance, Robert?
Yeah, I will try to put it in here before it ends.
And you can save, by the way, you guys can save the chat. Christine, you have to help me here. You want to tell everybody how to do it?
Yeah.
Yeah, if you're on Windows or have the main client, upper right-hand corner, you have some three little horizontal dots, hit save chat. that will open a little window near the bottom that says chat saved. If you click on show in folder, it will show you exactly where the saved chats are.
Thank you. All right. And I can cheat and look at that for all the questions we didn't get to, or comments that we didn't get to, and we can think about those for content in our upcoming ones. Should we do an official closing here before we turn off the recording, or have you already turned it off, Christine?
I haven't turned it off yet, but I do have one question for you.
Uh-oh. Yep.
Yeah, you'll enjoy this.
They're always the toughest.
Yeah. What is the only source of money that can actually buy an original T-bill?
I have no idea. Who is it?
I don't want to give that. I want you to look it up so I'm not
All right.
tainting your answer.
All right, we'll look it up. Say the question again.
What is the source of money to purchase an original T-bill from the Treasury?
All right. I'm gonna have to ask the AI for help. I'll do it. I have guesses, but I'm not gonna do it now. All right. Thank you. This concludes the session for the September meeting of the Northwest Suburbs Organizing for Action Fiscal and Economics Group. Thank you all for your great questions and comments, and look forward to seeing you all next month.
And it will be on the third Tuesday of October.